Welcome back, everybody, to Andy the Banker. This episode, I wanted to talk a little bit about technical analysis. I want to share with you guys what I look for in my companies. And not only that, there's a new financial term that I just been hearing so much the last, I don't know, 2 months or so, which is called the Trump put. And I want to share with you how I describe it, how I explain it. And I also want to talk about why the hell are there two Google stocks in the market. Let's get to it. The first topic I'll discuss about is the Trump put. What essentially is a Trump put? What do they mean when the media is talking about a Trump put? A Trump put is essentially where if the stock market keeps on going so much slower, the President Trump will come in and do things that will boost the economy, that will boost the stock market. It's not in a free fall. Now, the reason we came to a Trump put financial term is because it's so similar to what we consider a Fed put. Now, when we have a Fed put, on the other hand, right, when the stock market is coming down, crashing down, just like it did in 2020, the Federal Reserve, they essentially lowered interest rates or they printed more cash, right? They essentially did activities that helped the stock market go back to normal place. And that's essentially what we are hoping for in a Trump put. Now, whether that will happen or not, we don't know, right? That's essentially pure speculation because people are speculating that because in the first Trump term that we had a Trump put where President Trump had come in to the stock market and did things that helped out the stock market, people are expecting the same thing in his second term. Now, the second thing I did want to discuss a little bit about is some of the technical analysis. Something I find so darn interesting is the net profit margins of some of these companies. For example, you have certain companies that have super high net profit margins. You have, for example, the Nvidias of the world, right? At I don't know, 57% net profit margins. And then you look at the PE ratio they trade at, which is 37. Nvidia makes a huge net profit margins on the products they sell. For example, every single dollar they sell, about 57 cents is profit that they get to keep itself. The rest they'll have to pay employees, the supplies that they have to buy to make the products. Because Nvidia is a company that has a very high net profit margin, they get valued at pretty high PE ratio, such as 37 for Nvidia's case. Now, on the other hand, you also see companies that have high net profit margins, but they're trading at lower PE ratios. For example, you have Uber. I was not aware, you guys, that Uber actually trades around also a 56 or 57 net profit margins. Yet Uber does not trade at a 37 PE ratio. It actually trades around a 16 or a lower than 20 PE ratio. Now, one of the reasons for this could be that their business model itself could be disrupted, such as from Waymo, such as from Tesla full self-driving cars. Because of that, the company is getting discounted on its risk. As a result, they don't get to trade at those high valuations that other companies who have high net profit margins do. Now, what's interesting is that these are companies that have the high net profit margins. On the other hand, you have other companies such as Google itself, right? Google trades around a 27 or 28 net profit margin. So for every single dollar they make, they're making about $27 or 28 cents in net profit. For a company like that, it's one of the reasons why I trade in Google stock, because yes, although the company has legal issues, I look at the net profit margins and this is a highly profitable company. Now, why do I consider it so darn important? Is because if, for example, the company gets hit with tariff, right? When you have a company that has high net profit margins, the company has wiggle room to take in some of those expenses. All right. You have certain companies that have really, really low net profit margins. For example, Dutch Bros, right? And for people that don't know what Dutch Bros is, it's essentially a coffee chain where their net profit margins are less than 1%. Now, when you have net profit margins so low, it is essentially a red flag. Now, the reason why it's a red flag is because if at any point one of their suppliers happen to cost more money, they have to pay more for supplies, and their net profit margins actually go negative, now they're losing money for the products they're selling. Now, at a certain point, not every single company was profitable. There were companies like Amazon who wasn't profitable for a very long time. There's a company like Kura Sushi, like a sushi chain restaurant that is not so profitable because they're using that money to build more stores. That makes sense. But you have a case in Dutch Bros where they were profitable, but now they could be almost not profitable again because their net profit margins are so slim. That could be a red flag. Now, just because you have a low net profit margins doesn't mean it's end of the world, right? When you have a low net profit margins, it just means that you gotta push out volumes as much as you can. For example, you have a case with Costco stock where Costco has less than 3% in net profit margins, but the amount of volume that Costco does all the time is just so much that it's causing the company to be profitable. And the company like Costco, even though it has a low net profit margins, it does trade at a 57 PE ratio. It's not end of the world, but it is one of the factors that I use in determining my stock analysis. And the third topic I didn't want to share and discuss with you guys is why is there two Google stocks, right? When you take a look at all the stocks out there in the stock market, you'll typically just find one of them. One Amazon, one Apple, one Microsoft. But Google is a little bit interesting because there's two of them. There's Google A and there's Google C, two different ticker symbols. Now, both of the ticker symbols does represent Alphabet, the parent company of Google. But the main reason why there are two is because when Alphabet had just became a company themselves, one of the things that the owners didn't want to do is give away control of the company. They still wanted liquidity. They still wanted to use the money from public markets in the stock market, but they didn't want to give away the same type of rights. What they ended up doing is that they had two Googles, Google A and Google C. Now with Google A, you can vote for the board members, right? You can essentially, if I have a share of Google A, I have a vote in choosing the board members. Now that's important because the board members are who essentially they can hold the CEO responsible, right? They can hold them accountable. And you have Google C. Now Google C is interesting because you are able to benefit financially from the stock, but with a Google C company, you are not able to vote for the board members. Now, for somebody regular like me, a regular human being that doesn't have trillions of dollars, it doesn't really matter too much because at the amount I'm buying into Google stock, I don't have enough influence to change who the board members are. But for certain investors, it does matter. When you're Warren Buffett, when you're Charlie Munger, when you're the Bill Ackmans of the world, if you're an institutional investor, then yes, absolutely that the board member who it is does matter importantly. It's so important. And as a result, even though Google A and Google C are the same company, you might see a slight variation in the stock price. All right. The dividends they give out is essentially identical, but the stock price may differ a little bit because when you're an institutional investor, they are buying into Google A, right? As a result, Google A can sometimes trade at a little bit of a premium and it causes the stock price to be variated a little bit differently. But essentially, they're the exact same company, but with Google A, you just have the voting power to vote for board of directors. Now, the board of directors, if you are able to have a lot of board of directors that's on your side, you can essentially fire the CEO, appoint a new CEO, and you can essentially put pressure on the CEO, essentially hold them accountable. As a result, it's very important to have that type of power in the company that you're invested in. And with that, you guys, I'll see you guys on the next episode. Thank you so much for watching. Bye bye.